Hey everybody, this is Tim Dial here at Nexa Mortgage, and I'm going to go over some things really quickly here. Try not to take too much time, but I've put together several videos about some little down payment assistance niches that we offer and that we have utilized to help people buy homes. But I've not put one together that sort of includes all the programs. And so to I wanted to go live today to sort of get into that a little bit and get through a little bit more of trying to include all of them that I utilize. Now we have more available than I utilize, but I feel like the five programs that I use are enough to cover about everybody, and I've used them with great success and really like these programs, and so that's what I wanted to kind of cover today. So right now I'm going to share a screen here real quickly. Just a moment. All right, so yeah, that's a correct screen. So anyway, this is basically my website. It's extremelending.com, and I do have a section on here. If you go to resources, loan programs, and then go to down payment assistance, I have a down payment assistance. I was looking through it earlier, and I think it's a little bit out of date. So I am going to be doing some updating on it because we have programs available now that are not on here. Additionally, this says who's eligible. It says you must be a first-time home buyer or haven't owned a home in the past 3 years. That's not necessarily a requirement on all the programs now. So if you're not a first-time buyer, you can still obtain assistance. So, and there are more than one program that will allow you to do so. So I'm going to be updating some stuff on here, but I wanted to get into that a little bit here as well, just to show you that I do have this down payment assistance stuff on my website, but it is a little out of date. So I'm going to go through and update it. But just to give you an idea of the different programs, there are five that I utilize. Three of them are zero down programs, and the other two are actual down payment assistance programs that are slightly different from each other. The three zero down programs, two of them are very common and a lot of people know about. One of them is called USDA. USDA means you're buying in a rural area, and they do 100% financing if you buy in a rural area. USDA program does have income limits. So if you make too much money, then it can throw you out of that program. And if that happens, we'll move you into a different program that doesn't have income limits. So that's kind of how that works. There's also a program called VA that a lot of people are familiar with. You have to be a veteran, qualify as a veteran, and they have a certificate of eligibility they issue to you. If you have that certificate of eligibility, then you can qualify for a VA program, which is also 100% financing. And with it, you don't have any income limits or anything like that. It's a great program, but like I said, it's only available for veterans. Those are the two common ones that most people are aware of. There is a third zero down program that is newer, and it's only offered by one lender in the country. It's a lender that we do more loans with than anybody else. Nexa Mortgage is the top mortgage broker in the country. This company is called United Wholesale Mortgage, and they are the top wholesale lender in the country, and they only do loans through brokers like us. But anyway, United Wholesale Mortgage is my favorite company to work with. They do an incredible job, and they have the best service and things like that. And they do have a zero down program, the only one I know of that is a conventional program. It is their own product, so it's not offered by any other company. That, if somebody else uses Fannie Mae and Freddie Mac and things like that, they're not going to have this program because it is specific to United Wholesale Mortgage. And it is zero down for conventional customers. The big thing there is that most people who are going to utilize that program are going to be people who have a little bit better credit. If you have 680 or above credit, then it could be a good program for you. Because it is conventional, they do require a little bit better debt ratio than, say, the VA loan or some of the down payment assistance programs, but they do have a little bit better guidelines on that than USDA. USDA requires a little bit lower debt ratio than the conventional UWM program. So anyway, those are some of the possibilities. what we do when we get a loan application is we look at all of the possible options for somebody, and we try to say, okay, I think these are the best 2 to 3 options. I have a comparison that I can run with the different programs, and I can send that to a customer, and that way they know. Once I send them that comparison, they know, okay, here's an option I have, here's another option I have, here's another option I have, here's what the payment will be on each of them, here's how much money out of pocket I'll probably have to have on each of them, and things like that. So you get a better idea of what the difference is between the 3 programs or 2 programs or whatever it is. But I try to make sure that I fit people into the programs that are best for them and give them options if possible. So that's how that works. But that's USDA, VA, and the United Wholesale Mortgage Conventional Program. Those are the 3 zero down programs. The other thing that is relevant here is that these programs also allow sellers to cover closing costs, because there's not just down payment. You have 0 down, but that doesn't mean you don't have to bring money to the closing, because there are closing costs. So these programs all allow for sellers to cover some of the closing costs. Conventional program, normally you're going to be looking at a 3% max as far as how much they cover. So just as an example, if somebody's buying a $300,000 house, the conventional program will let the seller cover about $9,000, which is going to cover most of the closing costs on most loans. So it's a good amount. VA will actually allow the seller to cover 4%, and they have different ways of looking at what the closing costs are that they will cover. But most of the time, VA will allow you to cover about all the closing costs you're going to have on a loan for that 4%. USDA lets you up to about 6%. So those programs are going to let you cover most of the closing costs available. Now, the other 2 programs both utilize FHA, the down payment assistance. They are in conjunction with FHA loans. FHA allows the seller to cover up to 6% toward closing costs. And so just to get into the other 2 programs, the 2 programs I'm referring to, one of them is called EPM. It's an EPM grant program. So what they do is they provide you with a 3.5% grant because the down payment assistance, because the down payment required for FHA is 3.5%. So EPM provides you with a 3.5% grant to cover that down payment. And then you go out and you request the seller to pay closing costs to cover as much of that as possible. And that means less money out of pocket. Then the other program is offered by a company I really like called Lending Pros, and they have a down payment assistance program that gives you 5%. The 5% means that 3.5% goes toward the down payment, but then they also give you an extra 1.5% to cover some of your closing costs, and then you can still get the seller to pay some closing costs as well. So you end up with more costs covered, less money out of pocket. Last person I did a loan for on that, they had put $1,000 down as earnest money. They had also paid $600 up front for the appraisal, and at the closing they got the entire $1,600 back. So they basically brought no money to closing for their transaction because we had the seller covering some of the closing costs. The extra 1.5% covered the rest, and they didn't bring anything. The last EPM grant one I did, the borrower still had to bring about $3,000 in closing. That were the closing costs that they had to pay for that the seller didn't cover. So that gives you a little bit of an idea of the difference in the programs. The other thing I wanted to cover about that is the EPM grant's a great program, but it does have a little bit higher cost associated with it. And as a result, you either have to get the seller to cover more, or you're going to have to come out of pocket some with that program. With Lending Pros, their closing costs are pretty similar to just any FHA loan. It might be slightly higher, but not much of a difference. The other difference there is that the Lending Pros is not a grant. What they do is they put a 5% second mortgage on your house, and then you pay that back over like a 15-year period of time. So you end up paying like on average like $100 a month instead of having to come up with $10,000 or more at the closing for the down payment. they break it down to where you're paying like $100 a month for the down payment on that second mortgage is what it amounts to, something like that. Most people aren't going to do that for 15 years anyway. Most people who are buying using these programs will be refinancing within a year or two. And when you refinance, you'll be able to combine those two mortgages into one, get rid of that second mortgage, and then reduce your overall payment when you refinance so that you're not paying that extra $100 a month or so. So anyway, that's a little bit about how that works. I really like the Lending Pros one for people who are really, really strapped financially and don't have much money to bring to the closing, because it is the one that you will bring the least amount to the closing, because they do give you that extra 1.5% toward closing costs. So that's a little bit about how that works. But like I said before, we will look at your specific situation and try to figure out what the best option is for you, or the best 2 to 3 options are for you, and let you can kind of compare them. But if you only have, let's say you only have $1,000 or $2,000 in the bank, something like that, then I'm generally going to recommend that we go with the Lending Pros in most cases, because like I said, they give you that extra 1.5%, and that way you're not bringing hardly anything to closing. So if you put $1,000 down as earnest money, and that's about all you had in the bank or whatever, then chances are you're going to get that back at the closing if we're able to get the seller to cover some of the closing costs. So those are the 5 programs that I utilize to help people get into a house. You don't have to be a first-time buyer. We have some of these programs don't require a first-time buyer. Some of them do, but some do not. So we will get you into the program that fits you based on your needs and what your situation looks like. Additionally, to qualify as a first-time buyer, you don't necessarily have to be an actual first-time buyer. It just means that you haven't owned property in the last 3 years. So if you owned property 5 years ago, but you sold that property and started renting or whatever, then you're still going to be a first-time buyer today because you haven't owned property in the last 3 years. Additionally, one other thing is, if you're buying with someone who's not a first-time buyer, but you are a first-time buyer, you only have to have one person on the loan who's a first-time buyer to qualify as a first-time buyer for that program. So, if you have one person who currently owns a house, but another person who has never owned a house, and those 2 people are going on to buy a property together, they're still going to qualify as first-time buyer. So anyway, that's how that works. I wanted to get into that a little bit, but I didn't want to take an immense amount of time. I just wanted to cover some of those differences. One of the biggest reasons I see that people wait and are not ready to buy a house right now is because they don't have money, and they feel like they need to build up their funds before they purchase a home. And that's just not the case today. That's not the most important thing. There are ways to get into a house with very little cash. And the great thing about that is that then you can immediately start building equity. And one thing we know is that once the interest rates drop, the prices are going to soar on homes. They've been pretty stable over the last couple of years. They haven't gone up very much, but that's because rates have gone up. And when rates go up, less people buy. That less demand means that the home prices either stabilize or come down. We've seen a lot of that. So as soon as those rates drop, you're going to see an influx of people on the market or in the market to buy a home. That demand for homes is going to cause the prices to soar. It was just like 4 years ago that a lot of people who were buying a house were actually buying for over the appraised value, and they were bringing extra money to the closing to buy for over appraised value. And that's because the demand was so high that there were 5, 6, 7 offers on each house that came on the market. And it was such a high, there was such high competition for the homes that people were paying more than the homes were worth just to get into them. And then once the rates went up, the values of those homes either stayed the same or dropped. And so those people haven't really built equity yet, that paid over the appraised value. But right now is a perfect time to buy while the rates are high, because you get a better deal on the house when you purchase it, and you know that the rates are going to drop and you're going to be able to refinance it within a year or two. That's definitely going to happen. As a matter of fact, I won't be surprised if we have a recession in 2025, definitely by 2026. And when that happens, when the recession happens, rates are going to drop a lot. There's going to be a lot of buyers on the market. There's going to be a lot of people refinancing, and you're going to see prices really soar on homes once that happens. So anyway, that's pretty much it. I didn't want to take a ton of time on here, but I did want to get into some of these details pretty quickly. If anybody wants to reach out to me, my mobile phone number is 615-995-2615. And my email address is my first initial last name. So it's tdial@nexamortgage.com. And I'm always here to help or answer any questions you might have. And I am no pressure. So if you're not ready to buy right now, I'm not going to try to pressure you into doing it. I just want to be ready when you're ready to help you. So that's pretty much it. I hope that everybody's having a great holiday season, and I look forward to talking to you in the future. Thank you.